Let's bring in our market panel. Joining us now is Keith Lerner of Truist Wealth and Drew Pettit of Citi Research. Guys, happy Friday. Keith, how should investors rationalize the fact that we're hearing broad justifications of why the economy is decent, stocks should go higher, but most stocks haven't been doing that great?
Yeah, well, great to be with you on this Friday. That's right. Overall, we have this market that's up about 15%, but when you look underneath the hood, year to date, about 40% of stocks in the S&P are actually down. So it's a split market. It's also reflective. We have a split economy. And when we look at the S&P, we all know that the key drivers this year, that two key sectors, which are tech and communications and services, are really driving the gains. But that's the way the market composition is. And, if you're in an index fund, it doesn't really matter how you get there, right? It just is more difficult for active managers. I will say, John, coming into this year, you got to think about it. For the economy also has been more resilient than most people expected. The consensus coming into this year was 1% GDP growth. Now that's now up to 2.3%. And forward earning estimates continue to move higher. On a short-term basis, though, I do think we're into more of choppy waters. We upgraded stocks at the end of April, but now we think after a 10% rise since then that we're more likely to digest these gains. Yeah,
these index fund returns look like hedge fund returns in a really good year right now. Drew, what do you do from here with megacaps? That seems to me to be the core question. If an AI disillusionment period does set in, how will it start and how will it affect investors?
Look, I think it's going to start if you start to see the earnings revisions soften, especially for some of the AI high flyers. What we've recommended to clients in our thematic work is thinking about taking some of the outsized gains in the mega cap AI pure plays and rotating back towards more of the, let's call it the creators and some of the users of AI, not necessarily just the enablers like the semiconductors. I really think cyclicals, especially large cap cyclicals, can work here because we're in this new age of technology and efficiency, and I don't think the market is quite giving them credit yet. So take your AI gains and redeploy them into some of these areas of the market that are going to use AI to make their companies and products better.
Okay, so as we're mulling that over, Keith, you're saying that you think on a short-term basis, markets are likely to consolidate these gains. Short-term basis, does that just mean over the next quarter? What are you thinking? How do both geopolitics and domestic politics, if at all, factor into market effects?
Yeah, well, that's right. I think over the next few months, if we zoom out a little bit, this bull market has risen about 50%. The median bull market rises about 100%. And I'll also say, we just did a study today looking at when you have strong first half returns above 10%. In the second half, you're up 89% of the time. You add to those gains by year end. But I think, again, we've had these strong gains. You think about off the lows in April, semiconductors are up almost 40%, technology up almost 30% in 2 months before this little bit of a pullback. And I think what I'm, right now, you're really searching for new leadership, which really hasn't come out yet. So yes, there's potential for a rotation, but we're really not seeing it yet. So I think it's more likely that we digest these gains. And as you get deeper into the fall, historically, what tends to happen is closer to the election, you start to see a jump in the volatility index, especially around the September, October. Once you get through the elections, there tends to be a relief rally just as we get some clarity around the, who's in office, regardless who's in office. So I think that will likely play out. But I do think even as we looked at that second half, even though you tend to have gains by the end of the year, you also tend to have one or two corrective periods as well. We'd be looking at that as potentially an opportunity to get more aggressive on equities, but I think we have to be patient, and we're in a period that might be frustrating for both the bulls and the bears here short term.
Okay, finally, Drew, tell me about this complicated consumer picture we have. You can argue that Nike is about Nike, but it's a big consumer name. We've had a number of other sort of qualitative points with other earnings reports, some of which are bright spots, but some of which show concerns, particularly about that middle-of-the-road consumer.
Look, it's the strong get stronger. And it's funny, John, even the middle-of-the-road consumer, they're still spending, but it's what they're spending on. We've talked about this a lot on the consumer side. It's about experiences, whether it's your shopping experience or going to go see a concert, go out and do something. Honestly, if you look at airline stocks, they look great year to date. Some of the cruise lines look really good. Some of the booking companies look really good. But the physical goods have struggled a little bit. unless they have a self-help story behind them. So honestly, yeah, the picture's mixed. I agree with that. But you can still find good consumer stocks with good fundamental stories. And the market, whether you're a mega cap AI stock or a consumer name, it's rewarding beat and raises where it can find it. I think that's how this bull market is narrowing, not necessarily into sectors or a particular theme, but into beat and raise names. And we saw that in Q1 earnings. We'll probably see that in Q2 earnings as well.